All right, everybody, part two of the high yield dividend stocks ETFs. I've got a great comparison for you today to look at and use for your educational purposes. The best way to find consistent monthly or quarterly dividends and some growth. All right, here we go. Now, this is the same website that I showed you on part one. And I will admit that I was too hasty in my, we'll say, the disdain against AGNC or MSTY when I said, oh yeah, the erosion happened and I didn't get any gains. It wasn't overcoming the losses. Well, when I pulled up these charts to show you, I realized when I bought into them, it was one of the worst points of the market. And I didn't give it enough time. I didn't DCA. I just looked at it going, well, this isn't going to work, because I was using a lot of these in this website here. And I was comparing a bunch of these together on the basic charts, not using an actual return percent chart, like I'll show you here in a second. If I had done that, I would have seen it would have been different. Now, some of these do have an actual erosion. I'll show you later. But for the most part, the ones I was in would have done okay if I had just stuck with it. So that being said, you can Google something like this, best high yield accounts, whatever, stocks, ETFs, and then search through those and find ones that fit your style. But one awesome educational standpoint that you should use for a tool is stockanalysis.com has this wonderful chart. You plop in any ticker you want right there, and it's going to pull up and compare across all the time frames that you pick. And it's wonderful. And on top of that, as you move your cursor, it will give you the live price points of that time, and it will adjust it from the best to the worst in line. I was like, oh man, if I had found this back when I was doing, testing these out, I would have not been so silly. So let's go through this. So I have one here. Let's go to the 1 year, give it some time, right? And all I did was type in the tickers I like or wanted to look at and compare, and it just plopped them in this whole order for me. So JEPQ is more of a blue. SPY. I wanted to compare some markets that we really know, SPY or QQQ. So JEPQ and SPY are the ones down here, and they're pretty much close to the same. Now, granted, they're much different in price points. At this time frame, the SPY was $617, and JEPQ is $54. So take into account your buy-in cost for each one of these will be very different. AGNC is around $11, JEPQ is around $54, Palantir 64. So that's going to change how many shares you can get and how much dividend you're going to receive, right? That's just commonsensical math. But look at this. Let's take out, well, Palantir did so great this last year too, right? I mean, we're not shocked that the high yield ETF type of stock share here is that it did very well. I mean, we can take that one out just to help us out see the chart. MicroStrategy's MSTY was up and down. Of course, that's going to follow Bitcoin nearly exclusively, right? So as Bitcoin moves, so will MicroStrategy, or Strategy, I think is all it's called now, and then so will Misty. If you want more consistent income with much less risk and loss and volatility, Netflix would have been your game. That would have been the best case scenario. High point right here was at 16, and it dropped down to 13. That's not a gigantic move, right? But up here, going from 21 to 14, while in itself is not huge, it definitely will pull a portfolio if you have, like, 300-400 shares, right? So use this tool to find what you like. Now, I already set up 2 different tabs here. This one has JEPQ, Gold, Netflix, SPY, and MicroStrategies. The next tab over here has a mixture of other ones I like, which for monthly high yield accounts, I can always say accounts, I'm sorry, stocks. I don't know why I say accounts. QQQI, ET, which is an energy stock, and then of course we already had those ones. And I put them in there to compare. Let's go year to date. That's only that, which is 6 months, a little over 6 months. So we have Palantir, of course, leading. Then we have Netflix, which we expect to be leading, which was pretty smooth. Look at that, not too bad, not too bad. And of course, you have lower ones the last 6 months. The last 6 months have been crazy, right? We had the election, we had the peak of everything at the time coming into January. Then we had Liberation Day with tariffs, and everything just went wacky, crazy, dropping. And so this has been a little harder 6 months than the prior 6 months before that. But all that to say, you still would get a 6% return with dividends on the SPY. Of course, if you can afford the, what was it, $600, or even at the low point, 502, right? So you would have lost actually in ET last 6 months, this would be considered a NAV erosion, and a very little gain in the JEPQ. QQQI is right here. It's mixed behind it. So around 6% is what it would have been for the QQQI, which is, 6% on 6 months. It's not bad. Plus, you do have some growth if you were to DCA down into this valley. In the last year, to make it more fair, right, we have a much bigger growth in here with these other stocks. So definitely compare what you're wanting to do. If you're going to use any of these high ones, let's throw AGNC in here and see. Let's take SPY out and throw in AGNC. That's one I've done before. And red down here, 13%. 13%, and it's pretty flat, pretty even. But see, I bought mine like right here. Yeah, it was around $9-10, and then it just didn't go anywhere. It dropped to 8, and it didn't even get back up to 9s. And so I saw all of this drop that whole few months, and I'm thinking, I'm just losing. I don't know why people love this stock so much for everything. It was all over every page. For Realty, AGNC, what is it, the Pennant Park float one. They love that. Prospect, PSEC. One of our members in Discord actually today was talking about PSEC. Now he loved PSEC, but let's look at PSEC real quick. Let's compare. Let's take out Palantir, Netflix, and sure, and then we'll do PSEC. Look at this. Minus 33 in the year. Now, you might be thinking while you're holding these stocks, like PSEC, okay, I'm losing my value, but I'm getting my dividends. So if I just care about my dividends, then I'll be fine, I suppose. But you could do better. I mean, even if you were to look at, let's take that one out. Even if you were to look at PFLT, which I don't believe, if I remember correctly, did great. Red, flat, 0.56 in the year. And you would have had a huge drop here with Liberation period as well. So while it looks good and overall stable, you have to zoom out, as our leader Stockmo in our Discord says, when in doubt, zoom out, because I was in doubt and I didn't zoom out when I was holding Misty and AGNC, and actually I did have PFLT for a while. I didn't zoom out. I was just seeing the very narrow scope, and I lost some. I didn't have much in it. I was testing it, but I did lose some of it, and I didn't like it. I didn't understand it, and that this is why I didn't do comparisons the correct way. So use your tools to help you out, and this is how you find high yield accounts, that high yield ETFs or stocks that are going to benefit your portfolio and not make you worry so much. You can pick any one of these you want, plop them into the comparisons or into your platform to chart anything that you're doing here, and see what their overall chart looks like. If their chart looks like garbage, like this one, this not this this is gold. Gold's beautiful. That's not that's what I'm talking about. I'm talking about this chart, this yield max on MRNY. It's on a MRN DNA, type stocks, post COVID stuff. This chart is garbage. It's absolutely terrible. After COVID started calming down, it just, no one cared anymore. It was gone. So you'll never create a dividend that will catch you back up to the level at $15 from 2. Ain't gonna happen unless the whole market was to pick back up from that point and do it again, then sure. But at this point, this would not be one that you would pick. This is obviously NAV erosion. Your asset value is eroding by the underlying product. So test it, throw it in here. We had GLDI last time. That was the one I was just showing you. Look at that. This is the last year, do 3 years. Now GLDI from this point of mid 23 all the way over here to late 23 would have technically been considered NAV erosion, but it's not because the ETF itself is bad, or the stock is bad. It's more because the product underlying what it's doing is reducing in value, so it can only do so much. So in this point, yeah, you're having an erosion of your overall value with your asset. But of course, we had a large gain on that too. So if we went to the 3-year or 5-year, there was a huge loss in that too. So you have to watch your stuff. If all of a sudden this starts turning around on you and it's not looking like it's going to be picking up the way you need to, shift it, move it to something that's more productive on your end. QQQI would be one you could do, right? Other than this, did pretty well. Or any of the other ones that follow individual stocks, Netflix, Palantir, even AGNC wasn't too bad, 13%, and GLDI did 26 for this last year. We know that for sure. But just pop some in and see what happens. 62 cents, 63 cents on a share of QQQI with a 14% APY, compounding per month. I mean, that's nice, right? You want something stable, T-bill, your treasury bill is going to be paying you at a 4.5% rate, and it's going to fluctuate a tiny bit, but about 20 cents a share at 50, I think it's around $50. Yeah, $50 a share. It stays right around 49 to 50 consistently. The one last one I want to show you is called Week. It's an interesting one. Roundhill has it. It's $100, so it's twice as much as T-bill per share, but you get 125 per week. Oh, so it's a higher price to buy in. So you have to do the division and then see if they compare from T-bill over to week. They basically, it is T-bill. It's just divided by 4. Okay, it's running its entire system off of the Treasury T-bill. So you get 7-8 cents a share on $100 share, but it's 8 cents per week. So that's 32, roughly 30 cents. Yeah, if it's we'll say 30 cents and a month off of 100, where QQQI was 60 off of 50. But if you wanted something that was going to be weekly payouts that can compound faster over a long period of time, you could do this one. And again, and this chart is very stable. Just like T-bill. It's just the same. But they're fun out there. There's ones. So lots of ones out there like this. CLOA, CLOA, is ran by BlackRock. Same idea. It is also a higher paying ETF that's very stable, other than Liberation Day. And in fact, look at that. This one actually has gone up since its first inception. Seems like 50 to 51. Okay, that's negligible. Never mind. You gotta look at the charts numbers here. Looks very similar to T-bill, other than the Liberation Day. But really, honestly, 52 to 51. It's a $1 drop. It won't do anything to you, and it pays almost 6% at 24 cents for 51. So if you wanted something that was very stable, that did not fluctuate much at all, unlike QQQI, you could take a bit of a discount, right? But you have stability and you have basically liquid funds to use. Okay, I think that's about it. I don't have much else to say. I'm going to start repeating myself if I do at this point. And if you have any questions, tag me in the chats, and we'll go from there. But that is an overview on NAV, asset value, erosion, a few examples of what erosion looked like, a few examples of what NAV actually benefits. The asset value got better over the time, and then your total between your principal price point and then your dividends compounding into it, how that benefited the actual stock ETF. So there it is, and we'll see you in the Discord or on YouTube. Leave a comment. I will write back, I promise. All right, everybody. I appreciate it. Thank you so much. Have a wonderful night, day, evening, morning, wherever you are in the world. Okay. Thanks. Bye.
And I'ma do it again.